All right. Good afternoon, traders. Third time's a charm. Those of you who have suffered through me for the third time, I appreciate you. Welcome out to the Tradespoon live trading room. No, see, look at that. I can't even get them straight. Welcome out to the Tradespoon Active Investor Workshop, Profiting with Butterflies today. My name is Scott. I will be your host. Yeah, let's talk about it. Let's talk about butterfly spreads. I've been trading for a while and teaching for a while. That's me. I apologize. I was a little slow to start because I've had some stickiness in the system for some reason. It's just sluggish and slow. So bear with me today, possibly. I need to remind you, as always, that trading options in particular can involve substantial risk, may not be suitable for all investors. Please read characteristics and risk of standardized options prior to investing in them. Evaluate any strategy prior to use to understand risk and suitability. You must be aware of the risks, be willing to accept them in order to trade in these markets. Tradespoon and myself are not investment advisors, not registered with the SEC or FINRA. It should not be assumed that future trade picks will be profitable or will equal past performance. The information in this presentation is provided solely for general education and information purposes. Any strategies discussed, including and data, are strictly for illustrative and educational purposes. In order to simplify the math, commissions, fees, margin interest, and taxes have not been included in the examples used in this presentation. Those costs will impact the outcome of your results and should be considered. Lastly, I and/or the team of Tradespoon may have a financial interest in the securities presented on the trade picks. Vlad Karpel, Tradespoon founder, is also an investor and consultant of AOS Inc., which does business as Trading Block and Money Block, a FINRA and SIPC member broker-dealer firm. Tradespoon and AOS are not affiliated companies, and each firm's material is not endorsed by the other. Okay. I don't have slides, so we're winging it. So we're going to start off with just basic construction of a butterfly. And we'll talk a little bit about, what we're looking for and why, and we'll see where that takes us. So let's start with the basics of what a butterfly spread is, what our assumptions are and our objectives are relative to that. So a butterfly is what would fall under the classification of delta neutral option strategies. So when I say delta neutral, I mean a delta positive strategy would be bullish. We want it to go up, buying calls, selling puts, bull put spread, bull call spread, diagonal spread, things like that. Then we have our delta negative strategies would be our bearish strategies. Buying puts, selling calls, bear call spreads, right? Things along those lines. And then we have our delta neutrals. So your delta neutral family of trades would include things like calendar spreads, butterfly spreads, condors, or iron condors. Those would be the types of strategies that we are interested in exploring. And so of those, the delta neutrals, right? That's the first. So when you use the Greeks, I think, to help determine, what strategy and why, it starts with delta. What direction? So what direction do you think it's going? If you think it's going bullish, you're not going to put a butterfly on. You might break the wings. We've done that recently, a broken wing butterfly. So that's a slight variation that gives some of the characteristics of a butterfly and some of the characteristics of a more directional trade. So anytime you're evaluating what strategy should I use, start with that. What direction are you trading? Now, let's pull up a chart. And you can see this is actually kind of a sideways chart with a sideways projection. So it actually would be a trade that could make some sense in the short term here on the SPY, the IWM. Is another one that has that same kind of a maybe of a sideways. So a lot of the markets actually right now do. Even the QQQ. So let's go look at the actual charts. I'm trying to see if there's one that stands out more than the others. So if we think it might go sideways, now if it goes bullish, it can put you in some pressure. So that's the consideration, is if you think this thing might grind sideways here, maybe it tests a little lower, but overall it kind of stays in this range. A butterfly can do very well, particularly because the next consideration right after delta. So what direction do we think the market's going to go? The direction we think is possibly sideways. And again, a butterfly is going to be a strategy that works well in conjunction with other trades, where I might end up with a butterfly on the market and then 3 or 4 bullish trades, with the hope that I would be able to adjust the butterfly possibly to be more directional if the market does go directional. But if not, I keep my loss a little smaller and more than offset it with the profits made from the directional trades. Um, the second consideration then becomes Vega. So after delta is considered, after direction is taken into account, we look at Vega. What is Vega? The sensitivity to changes in implied volatility. So in order to assess what type of Vega we want with a trade, we need to assess how do we see volatility now, right? So if I were to draw some lines here on this chart, and I'm going to be down on the bottom with down in here, this is low volatility all through the bottom of that line, right? That would be considered low. Everything else, and you'll notice it's not a lot, right? If I draw my line here, the vast majority of the time has been down in that lower area where we have low volatility. We had some higher volatility there, just a blip, a little bit more than a blip, and then we have now. So as we see this pushing up into these mid 20s, that's where we say implied volatility is high. If the volatility were between 15 and 17, I would say it's low, probably going to go higher. If it's up here at 25 or so, I would say it's high and more likely to go lower. So how does that influence what strategy I pick? If I think volatility is going higher, I want to be Vega, that's what I'm writing, Vega positive. If I think it's going to come down, I would prefer to be Vega negative. Vega positive versus Vega negative. So what would that lead to by way of strategy? So if I want to be delta neutral and the volatility is low, I would want a delta neutral strategy that is Vega positive. What would that be? Calendar spreads. If I am delta neutral and I think the volatility is high, what do I want to be? I want to be Vega negative. So what would constitute Vega negative delta neutral strategies? Butterflies and iron condors. Butterflies and iron condors. Now, an iron condor, here's the interesting thing about a butterfly or an iron butterfly or a condor and an iron condor. They're both a combination of a bull spread, which looks like this. That's the risk profile, and a bear spread, which looks like this. Now, if I connect those two, like that. Now I have an iron condor or a condor, depending on whether I use two credit spreads or a credit and a debit. Do I have a cheat sheet? Unfortunately, I do not have a cheat sheet. Um, Boy, that's a great question. You know what, David? That's something I might look to. I'll try to put together for some of these strategies where I can have a document that I can share with you guys. I love that suggestion. Just a quick little cheat sheet because before we had slides and you could print them, but even then it wasn't necessarily a cheat sheet per se. But yeah, I like what you're talking about. Now, if I take a bull spread like this and I stack it with a bear spread like this, where the middle strikes overlap, dun, 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 that is the butterfly. So there's the butterfly and the condor, or the iron butterfly and iron condors, are they're really not that dissimilar. They're really not that dissimilar from each other, right? What are they? They're delta neutral, right? What does delta neutral mean? I want it to stay this one right in the. They're vega negative. I'm a seller. I want to sell when volatility is high. Are they cheap? Well, so it's not necessarily cheap, although a butterfly is a debit. So an iron condor is a credit, and a butterfly is a debit, but they actually have very similar prospects. Let me actually show you this. We'll just sort of wing it and see where it puts us. So I'm going to go into IWM, and actually I have a butterfly right here, but I'm going to start over. Okay, so I'm going to show a butterfly with an exact example, Devondra, exactly what you were looking for. Stock right now is at 221.29. I'm actually going to build this a little bit below. So I'm going to go 218, 208. Where are we now? We're right here. No, I'm going to do the opposite of that. I'm going to go 225 in the middle. 215. There we go. And this is where we are now, about 221. Is that too far? Let's make it just a tad more neutral. So you'll notice what I'm doing now. This is where we are now, right here in the middle. So this is the structure where I can make money. Now, what am I doing? I'm buying the wings. So the wings would be 215 and 235. So I have a wing here and a wing here, which corresponds with this strike price. You can see here, I am a buyer. Here, I am a buyer. Buy the wings and sell the guts, and the guts are twice. So in actuality, what I have here is I have a 215 by 225 bull call spread, and I have a 225 by 235 bear call spread. That's what a butterfly is, a true butterfly. An iron, whenever you put the word iron on a spread, that means that you're utilizing credit spreads on both sides. So an iron butterfly would be a bull put spread from 215 to 225 and a bear call spread from 215 or 225 to 235. Two credit spreads on top of each other, but same exact prospects. An iron condor is a bull put spread and a bear call spread, only they're wider, right? So I could do 215 by 220 and then 230 by 235. That, lopping the top off, that would be an iron condor. I can do a condor, which would be all calls or all puts. So that's the differences, right? Those are the differences with what we're trying to accomplish. So it can be very confusing. I remember when I first learned them, and I'm like, what's the difference between iron and regular? That's it. An iron condor or an iron butterfly are just using all credit spreads versus a standard condor or a standard butterfly, which is using a debit and a credit combined using the same strikes. Those are the same strikes. Now you'll notice, what do I have here? Delta, relatively small. I'm delta neutral. Now, if I put this right on top, so somebody asked, what do you get those strikes, the wings from? Is there any reason we have not put any irons on with me in the past year? Well, we've done a couple on round earnings, but I'll be honest, I don't tend to use iron condors when I am neutral. I tend to use butterflies and calendars. So we have done plenty of calendars and butterflies, more calendars recently than butterflies because volatility has been low, but that answer would remain true with iron condors. So with implied volatility lurking down in this level, with implied volatility lurking down in this level, there's not a lot of premium. Now, if in these areas here you had done an iron condor, the problem is we tend to have much more directional orientation during that time. So I'm not, for me personally, I am not a huge fan necessarily. It's not like I have anything against them, but I actually prefer butterflies to iron condors because whichever way they go, I have at least the potential to make an adjustment. So let's say, for example, I start with this trade right here, okay? And where these are coming from, typically what we're trying to do, so what do I have here? I've got IWM. I'm thinking to myself, it's going to stay above, let's say 215, but below 220, right? Above 250 or 230, above 215, but below 230. That's what I'm going to try to structure around this trade. So you'll notice that I actually would probably be more beneficial to make it a little bit more a little bit more neutral. So let's take it down to, let's say 212, 222, 232. And now you'll notice between 215, this triangle is where I make my money. So if this triangle exists between 215 and 230, then now you'll notice that I am in a good spot between, and thank you, Paul, I'm going to share that with everybody if you don't mind. Now between 215 and 230, as long as it stays in that range, I'm okay. What if it doesn't? What if all of a sudden it breaks out and does something like this? Then I might be in a little bit more trouble and I'll need to either add something directional to it or put another piece. Now, if I still have some level of neutrality, I can combine butterflies. So I can take this butterfly and I can say, what if I need to go, let's say 234. So I'll go 224, 234, 244. And now you'll notice it's not an iron condor, but it's close. It's like an iron condor with bat wings or bat ears, right? So this is what an iron condor would look like. This just has a couple of bat ears around the center of each of the butterflies. So rather than put a whole iron condor on all at once, I can put one side on and then decide, do I put this trade above, right? Because if this breaks to the upside, now I'm good from 217 to 239. Or I can put it on to the downside, and I could say, let's see, 12, 210. I could say move this down to 200, to 10, to 20. And now you'll notice it's the same structure, but now that structure exists from 205 to 227, right? Although I'd want to unlock that and it would look something like this, 205 to 227. So I have a little bit more flexibility. Now, Paul was generous enough. I'm gonna take this. He said, this is a cheat sheet for any options strategy. I'm gonna copy this and send it back to all. And you should have that link. I appreciate that. Take a look and tell me what you think. Let me get rid of these lines. So that is a butterfly. If I start with this neutral range, what do I have here? You'll notice I have delta. It's negative, but it's pretty small. So that's what I mean when I say delta neutral. Delta neutral doesn't mean I have a zero delta. It means it's going to be pretty small. Theta is positive. So if you're wondering, well, if it doesn't make money from direction, how does it make money? It makes money from time. The more this thing moves, the more time value gets pumped in. And I actually have value to either side. It expands beyond what I have in here. Out to these outer edges, right? We have a little bit out this way, a little bit out this way, and it gives us this entire range. So there you go. Now, what if I'm somewhat neutral, but I think it might be directional? Well, if I think it might go to the upside more than the downside, I have the ability to break the wing. So I could cut this other side in half. Instead of going 222 by 232, I go 222 by 227. And you'll notice it still gives me the makings of a butterfly from 215 through 227. So if it sits in the middle and just kind of stays range bound, I make money from time. But if it makes a move to the upside, then I have at least a fixed maximum gain. It's not a huge gain, right? You're not going to get a very strong bullish upside trade that has both middle ground of time decay working for you and a big directional trade. If you're very directional, you would build a very directional trade. This is I'm mostly neutral, but if it goes, it could go to the upside. And this is actually something that I'm thinking about for the market that we're in. If the market that we're in sorry, give me 1 second. I'm a little bit locked up here again. If the market that we're in, so let's go back. Let's take a look at the VIX. So it was a nasty day today, right? Very nasty day. But we've seen stuff like this before that peters out pretty quickly. Maybe it goes a little higher, and then we doji, and then we turn over and start to drop back down. And this becomes a lower high. In a situation like this, I would think, you know what, this could just kind of grind a little bit, or it could turn bullish. So if it grinds a little bit, what would I have? I would have a neutral trade around the middle. But if it goes bullish, what would I have? If all of a sudden the market went bullish, we actually did this. What was it on recently? Facebook, I believe. Was it Facebook? I think it was Facebook. Let's see if I can find it. Yeah, I think it was around here, and we put a broken wing butterfly on right in here, and we said it could go neutral. And you can see it did go neutral for a while, and then all of a sudden it popped. Well, when it popped, there's not much you can do. I took maximum gain, but it would have made more money if it would have just sat around. So if when we come out of this little consolidation that the market is in, if this thing pulls back a little bit more and stabilizes and starts to turn, you might think, you know what? It could, but this thing could just be right back in this sideways range. But if we get a Santa rally, it could do something like this. And if I had a standard butterfly and it ended up out here at 235 or 238, and I had a standard butterfly, then I'm going to be in trouble. Right? If it gets up here to 238, all of a sudden this trade's losing money, and I'm like, wait, what do I do with this? Now, if you ever have a butterfly on, remember, you have the ability to leverage it. Like I said, this can work well with other trades. I have this big chunk of time decay. So if it gets out into this area out here where I'm like, that's crossing a bad line for me, I have the ability to either A, try to put another neutral trade on to connect these two, or if I'm even more aggressively bullish, I could put a bullish trade on, right? Where I put a bull call spread, something where I put a trade that does this, where it starts to show me. Let me show if I can show you that. Let me know if you have any questions about the basic structure. You buy calls on the outside, you sell them in the middle at a 1-to-1 ratio. 10, 20, 10, 5, 10, 5, 2, 4, 2. You're always selling 2 in the middle, and that creates the bull call spread on the downside, the bear call spread on the upside. But if it were to, let's say, get out here to 229, it's down a little bit, some time has passed, and I think to myself, you know what, now I'm going to make this November's just to make it easier. Oops. Then I might add, let's say, a bull. Let's say like a bull call. Where was I? So let's maybe do like a 230 by 235 bull call spread. Okay, so this is a little short, but even something like this, where you kind of acknowledge that if it gets stalled out, I would probably go a little closer. Let's try 238 by 233. And then I have a whole different profile, right? yeah, it kind of bottoms out right here. So anything between 228 and 232, it's not going to help me. I would only do this if I'm bullish though. So 228 to 232 is still in this range. I would only do this if I was bullish and thought we were going to head on up towards 235 or 240, breaking out to new highs. And then again, you're not going to get a huge amount of money, but here's what I want you to think about. This is a strategy that we expected to stay neutral, but that gives us the potential, if it looks like it's breaking out, to make a bullish adjustment and then have that in addition. Um, yeah, so you'll notice that it would be, in order to gain something, we have to sacrifice something. So you would be sacrificing here. So it would either have to continue up or fall back into the middle of the range. And let me show you how this would work over time. Dennis says, I use puts instead of calls because getting assigned short calls results in a short stock, while getting assigned short puts ends up with a long stock. I see what you're saying. I'd have to think about that. I'm typically doing butterflies on very large stocks like IWM, QQQ, SPY that don't get early assigned. So it doesn't look like you lose anything. Well, you wouldn't lose necessarily, although you probably would lose a little because this is going to cost more than it does now. So if I end up, let's say, paying 225 for this because it moves, then this will be slightly underwater in here, but not till the very last day. Let me show you how this would work over time. The time would just keep on pumping higher. It would actually extend beyond, and then it just sort of flattens out on the right side, but continues to give you this here. So it's not till the very, very, very end. I see what you're saying. So Dennis said you can't hold shorts and IRAs. Yeah, that could make a difference. There you go. I agree. I agree. Now, as this time comes to close, it's not till the very, very, very end, the last day. You should be fine on this trade all the way until the last day. That's why I'm okay having a little bit of this underwater, because in the meantime, I have the rest of this. So as I look at, neutral strategies, what I have come to realize is that my preference is to make neutral strategies that I can adjust, and I can add something too. So if I start with a butterfly, I can add another butterfly. Or I start with a butterfly, and if the market goes up and the volatility drops, I might add a calendar. Look at the theta. Yeah, right. Only on that. This is literally the very, very Friday of expiration, David. So it's not normally going to look like that, right? Although I mean, I have had times where it does. And the trade we had on Facebook actually had something similar to this, where if it would have just fallen, I could have made 3 or 4 times as much money. It didn't fall, right? And so I do like butterflies, as long as it's positive, baby. You're right about that. You are absolutely right about that. And that's the objective here. Anything we're doing with butterflies, calendars, um, um, iron condors, those are all going to be um, theta positive trades unless they move against you, right? This definitely becomes theta negative out here. But as long as it stays out in this range, we're okay. Now, the problem is if you don't make this adjustment, if you wait too long, then it won't work this way. If you wait until this is out here at 236 and you're already down on this trade, boy, that's a lot harder for you, because remember, what you would have to do is you would have to make enough money to profit or to overcome this loss. And you don't have that much over here. You have some over here that can help, but you would have to, overcome that amount of money. Assignment risk on X dividend day, you can end up paying the dividend. Yeah, if there's a dividend, there are definitely extra considerations. Now, sometimes when you build butterflies, and this one is a little bit, you'll notice that this one is a little bit delta negative. So what that means is that this thing could actually, from the starting point, it could drop down to here, and I wouldn't start losing money until it drops through 208, which means that as long as I don't think it's turning into something really nasty, I could add, remember that what's going to happen if the stock drops, the volatility is rising. If the volatility is rising, the next butterfly I put on will have actually more premium associated with the first one. And so if this were to drop down here, I could add a second butterfly and then sit on the whole thing and just let it recover. So in that regard, what I believe the butterfly gives us is a delta neutral, theta positive strategy with flexibility. I have the ability to adapt it and adjust it if I need to. We actually did a few butterflies recently, and they went against us. And they went against us in a way that it wasn't clear we needed to adjust it bullishly. So we just kind of sat, and they stretched us a little bit. I mean, they really stretched us. Finally, at the end, it came back a little bit, and it ended up not even getting in the money, but close to into this triangle, but close to it. And we were able to shut them down for profit. And so that's another thing that they offer, is they're just not these fast moving, really hard to control, hard to contain, or anything like that. They're just, they just give us some flexibility. So if you are doing a neutral strategy with high volatility, the other potential would be an iron condor, but the iron condor doesn't have, it's already got 2 trades. How far out do you go for time? I would actually think about the Novembers. I would say anywhere between maybe 35 up to 60 days, 35 to 60. And you can see that, in here we have 31, 38, and here we have 52. So I think the Novembers would actually make sense. And they just bring balance, right? They bring balance to your portfolio. If you find that you are theta negative and you need some positive theta, if you need to bring balance for your Vegas because you have more positive delta or positive Vega than not, I mean, there's a lot of ways that these can be useful. But essentially what it does is it brings, if sometimes it's hard because you think, oh, the market's trending. I've seen estimates that say the market's only trending 30 to 40% of the time. And you got to think, what about the rest when it just grinds and grinds and grinds? Like this on the IWM. It's just been grinding and grinding and grinding. Hard to make money from direction. So diversification for an options trader is not by stock, but also not just by stock, but also by strategy. How can I bring balance to my portfolio by combining strategies in different areas? So when this market starts to stabilize, my thought is, okay, we might go neutral for a while, butterfly. If it starts to show signs of bullishness, then I'm going to think, okay, now I want to get more directional. Does that mean close the butterfly? No, because at that point, the butterfly becomes a hedge. It converts itself into an inherent hedge that If the market starts going up and I start adding bullish trades, those bullish trades should make money if the market continues going higher. If at some point it stalls and drops back, then I'm going to have to say, what do I do with these bullish trades? And then I have this butterfly where it just falls back into the range, right? And so when you see this and you're out here somewhere thinking, do I need to do something? We actually found ourselves probably out here. I mean, it was a little bit outside, but I didn't have enough information to say I need to make an adjustment. I'm glad I didn't, because it did end up falling back into the range. That's the other thing. You'll notice this purple line is very smooth and slow. It doesn't move up fast or down fast. It's nice and steady. And that's something that there you go. Thomas was saying it right as I was. It's very slow and steady so that I have time to say, do I need to make an adjustment? Let's wait another day. I don't have to panic and hurry and slap one on. In fact, that's the worst thing, right? Is to do that. I've had that where I've put adjustments on only to be like, now I don't need that adjustment. So there it is. I'm trying to think if I missed anything. Are there any questions? We still have a few minutes here to chat about this. Delta, right? Start with direction. Are you neutral, or do you lack neutral? If all you have is directional trades, the question you start to ask is, what would happen if it just grinds sideways? Because if you're not going to make any money, then you might say, hey, you know what? Let's add that. Let's add that. Because if I add that and we go sideways, this could be a beautiful trade. If I add it and the market goes up, I could say, you know what? I'm going to shut it down out here. Take a loss of a few $100s. But if I have a bunch of bullish trades, I'm going to more than offset what I would lose from this with the other trades. And that's where seeing your portfolio from a total perspective is definitely something that I would recommend that you do. It's just as important to learn the adjustments, David. I think even more so. That's a great comment. I think even more so. The adjustments for your neutral trades are the most important. Scott, did I see your question? How to fix a bullish butterfly? Oh, okay, I didn't. Oh, I did a 445, 455, 460. So that's a broken wing butterfly that's now underwater. What would be a cure to fix it? I'm thinking you're saying on the SPY. 445, 455, 460. Whoa, that's tough. So a broken wing butterfly is a directional trade, right? It is a directional trade. And so there has to be a line in the sand. The one thing that I think you could do is possibly put a 430 butterfly on top of it. So that you basically, if it stays here, it's buffered. If it goes back up, it gets back to your original butterfly. But even if you did that, and it might not work to go all the way down here, you'd have to maybe do that around, 440 or 435 in the middle. And that would give you maybe an extension to hold on to it where that starts to make money. And then eventually you get a recovery. But yeah, expires 10/15, so there's not a lot of time left. That's the other thing about adjustments. We need there to be time in order to adjust. Yeah, so that's what I would say. Look into the possibility, because with the volatility up right now, another butterfly might work. But if you did put another butterfly, there would have to be a line in the sand where you're like, you know what, if it closes below this 100-day gotta shut it down. At least close the broken wing butterfly and possibly see if the other butterfly can stay. But that would be the only thing I could think of. You'd maybe want to run those numbers on the analyze tab and see what you come up with. So yeah, when it comes to calendars or butterflies, it's interesting. Way back when, I used to work with the guys who built the Thinkorswim platform. And they loved iron condors, and they would actually do iron condors with a calendar spread on the upside and a butterfly spread on the downside to bring extra balance to them. However, what was interesting was I did that strategy for a while, and then one day I sat and I said, okay, let me look at just the calendars. And I wasn't ever making money on those. And look at just the butterflies, and I realized I was putting these on and they weren't really helping. So it actually kind of pushed me into a situation where rather than start with an iron condor where I try to put something on to boost up the outside edges, I would rather start with a more narrow delta neutral strategy where if it goes up too much or down too much, then I could make the adjustment. Then I could make the adjustment there. So great questions, great comments, really high level options trading stuff. So you'll notice that I integrate the Greeks with any options discussion, especially something like this. So if you aren't as comfortable with things like delta, theta, vega, I would suggest that you look into it, study them a little bit, understand them a little bit more. If you are looking to find a source for that, there is in the archives a Greek presentation not too far back. So I don't know if you knew this. Let me take just a second and go backwards in time. And let me show you. If you come into event recordings and you go to the Active Investor Workshop series, let's see. Swing trading with spreads, earnings, patterns, time-based. I think this was calendars, time-based strategies after earnings. Credit spreads. Oh gosh, maybe it's been a while. Man, it was way like my memory is so bad apparently. January 5th, option Greeks. Go watch that workshop. That's a good one. And that should maybe help where we talk theta positive, delta positive, vega negative. Like, what does it mean? How does it influence my strategy? So to summarize, remember that butterflies are neutral. They can have directional aspects if you push them up a little or down a little, or if you break the wings. They work very well to complement your portfolio, to bring positive theta, negative vega, a little bit of balance to a portfolio so that if things just kind of grind sideways, you have something working for you. They are adjustable, and the adjustment, that's where the sweet science is, right? Is when you can start with one trade and then have the ability to make an adjustment to convert it into something else if the technical analysis dictates that you need to. So yeah, go take a look at that. Practice them, right? If you've never done it before, paper trade them a little bit and get a couple of cycles under your belt. Don't just slap one on and then find yourself in the weeds trying to figure out what you need to do next. So get a few paper trades under your belt, or at least maybe make it small. I mean, a trade like this one here, literally I could do one contract just to kind of start to get my legs under me, and that's $199. Worst case scenario, even if things go terribly wrong and you don't make an adjustment, you should be able to keep your risk at half. So $100 of risk to get a live trade, some skin in the game, that would be an option as well. As we talk about this in conjunction with delta neutral, the other strategy is iron condors. We haven't done one of these with iron condors, but this like iron condors is Vega negative. So if there's ever a time where you think, oh, volatility is going to drop, when do we think volatility is going to drop? Coming out of earnings, right? When they announce earnings, we typically see it drop. Paper trade means simulated traded. Yes. Yes, simulated trading, paper trading. It's interesting because it says simulated trading here, but if you go to log into it, it says paper trading. There you go. All right. Well, whew, that was a lot today. I'm a bit tired. Third one, 3 presentations in a day. I haven't done that for a while. I will be back tomorrow for the trading room. So I hope you'll join me for the trading room. We're at a pivotal point in the market, I think, right now. And we're about to get, I think, the information we need to help us understand what's coming next. January 5th, Greeks. Absolutely right. Thank you, Thomas. I appreciate that. I'm glad you enjoyed it. I sometimes think that I take certain aspects of trades for granted and I try to rack my mind to make sure that we go through all the different elements. But hopefully you see, I like to do these on the platform and talk about it from an application standpoint. There is no January 5th. January 5th watch workshop. Yeah, it should be. It looks like it's there. Yeah, go into the archives, go to option Greeks, which should be on January 5th. And it should be there where you just click watch workshop under the archives and go back. So, all right. Well, thank you. Thank you, David. I appreciate that. And I appreciate your participation. Great insight and questions. Thank you, Thomas. And I hope you guys all have a wonderful rest of your day. Join me the rest of the week if you're in the trading rooms. If you're just checking out what we do here, we do education, we do trading rooms, we talk psychology. We try to do a lot. We have a great community. So if you're thinking about it, sign up, join us, come in. You won't regret it. And for those of you who already signed up and are already in, we love you. We appreciate you. We hope we're providing what you need, and join me for the rest of the week. Have a great rest of your day. And as always, happy trading.